Welcome back. You're listening to Agriculture Today and an extended look at the top influencers of the grain markets in 2021 and some thoughts shortly here on what 2022 may portend for the grain trades. Again, our guests are Guy Allen, senior economist with the IGP Institute at K-State, and K-State Research and Extension grain market economist Dan O'Brien. So we covered what we're calling, again, the macro issues earlier. Now it's on to what we're dubbing the micro issues. And Guy, first and foremost, perhaps there, and this is not unusual, the weather and specifically La Nina's influence on grain production here in the U.S. and beyond.
Yeah, I think the first half we were looking at a lot of the drivers of demand. I think these last five things we're going to talk about are really production issues. And excuse me, last year was a La Nina year, and we definitely saw the impacts of that. Starting off with sort of dry weather in the northern plains and into Canada, we saw a significant reduction in their wheat crop as well as their canola and barley crop, dropping their total wheat production down by over 38%. We saw a drop in their canola production of over 35% as well for barley. And the big one that stands out is a 43% drop in their oat production. We've seen that drive both oat and canola prices to all-time highs on that. So quite interesting from a Canadian situation. That drought also significantly impacted the northern plain states there in U.S. production.
And it hasn't abated. When you look at current international maps from looking from the northern plains up into Canada, those areas largely are still dry, and it's not unheard of to have dry conditions. Will it persist right now in terms of U.S. wheat? And again, that's the first thing. It's in the ground. Well, the winter wheat's in the ground, but we have 53% of the U.S. winter wheat production area is still experiencing drought. And as far as spring wheat, that area where they'll be planting into 2022, 69%, 86% of durum wheat still there. And there was some, we don't talk a lot about durum wheat, but durum wheat per bushel in the 20s I heard of, at different times. People were just so tight at different times in terms of getting needed durum supplies. So we'll see where things go, but we're setting up to have weather market concerns in the wheat complex persist on into 2022.
An interesting thing on the feed grains, Canada always buys a bit of U.S. corn, but they're going to become a significant corn importer this year. We're already seeing significant tonnage move across the border into the Canadian feedlots. Beef feeding margins remain pretty good, but they're going to show up, I think, definitely in that top 10, if not the top 5 corn importers this year.
Speaking of feed grains and row crops broadly here, we look to the south where it's dry in parts of South America. Argentina and Brazil production, well, that's something in question right now, is it not?
Yeah, look, we've watched those South American crops pretty closely last year, and I think there'll be even a closer focus on that this year as that dry weather persists in both Brazil and Argentina. Look, that second crop of corn was pretty key in Brazil. That production dropped from 102 million metric tons in 1920 to just 87 million metric tons in 2021. Argentina's wheat production dropped about over 2 million tons as well. And those are key sort of counter-cyclical exporters of grain. And we watch that pretty close as these global balance sheets are running historically very, very tight.
I think the thing to remember also, to add on to what you're saying, Guy, is that the USDA's plan, their projections for 2021-22 includes those South American crops that aren't harvested. A lot of their growing season comes in the first 6-8 months of the year, first part in particular. And we're seeing a projection for world feed grains, world corn, world soybeans to actually increase, that stocks will be less tight, but that's all, quote, betting on the come. on what will happen. So we're not trying to sit here and roil up markets and just gin up volatility and worry, but the presence of La Nina, it holds forth the idea that the markets have to deal with that the crops they're planning on, that USDA is writing in right now, aren't assured. And so we'll have a weather market. Even before we get our own crops in the US planted, we'll be watching weather closely now for January, February, March, April, to see what happens in South America. And if they tighten up, then who knows? Now you look at Mato Grosso and some of those key areas, they right now have moisture, but analysts are talking about how in coming weeks things are looking drier. And my understanding is they have soils that don't retain lots and lots of moisture, so they need moisture to keep coming. And I think we'd seen last year, as you'd mentioned, Guy, that dry conditions after the first of the year in South America really affected the markets.
Yeah, look, we're running these global stocks to use ratios pretty tight, as well as particularly in the US. So any small changes in your production estimates are going to have a significant impact on current values on that. And that's really going to drive that volatility going forward.
And just as a brief sidebar on this, Guy, the dryness in South America could interfere with whatever grain movement there is in regard to one of the key river passages there.
Yeah, that Parana River was shut down a few months ago. The water levels on the wake of the dry weather just got too low to be navigable. That changed some of the trade flows, particularly for Paraguay, which is a bit landlocked. It was forcing that corn to actually be trucked across the border into Brazil, who was actually having an end of season shortage of corn, but also inland Brazil moves some of their production down that Parana River as well, causing just logistical concerns in the supply chain. Now that river, I think, is pretty much shut down till they receive regenerating rains, and I think that'll be probably later in 2023 to get those water levels back up where they're commercially navigable again.
Looking to another region of the world then, and once more territory that you're quite familiar with, to say the least, Guy, having spent many years there. Australia, which had numerous years of devastating drought and difficulty in productivity, has had a pretty good run of late, right?
Yeah, look, La Nina isn't dry weather everywhere. There's for both China and Australia, there's a correlation between La Nina and wet weather. And as we say in the grain trade, rain makes grain. And what we've seen last year, Australia had a record crop, and they're breaking those records again this year as that crop currently comes off. Look, they're expected to produce about 58.4 million tons of total winter crop production, with a record wheat crop that just got raised again to 34.4 million. The world is really counting on that crop. It was really looking to it for quality wheat, as well as canola, to substitute for the shortfall in Canada. However, we have continued to have some untimely rains during harvest that has really downgraded quite a bit of that wheat production, particularly in the eastern wheat belt, where we grow the higher protein wheats. And some of that downgraded wheat has been finding some homes, but at a discounted price. So it's definitely tightening up the quality balance sheets for your higher protein, mid-protein quality wheats on that.
And you note that China is having its own troubles with floods. So that's another piece of the puzzle.
Yeah, look, I think that's again, a La Nina effect. They've had some record rainfalls in some of those areas. They have what they call the plum rains, which come in midsummer this year, which were exceptional, threatening some of the dams, and the flooding, significantly reducing both the food and the crop production. It's really hard, though, to get a handle and assess exactly what the impact on production and what those losses are on that.
Dan?
It's the China grain market wet soil syndrome part 2, because that sounds like exactly what happened last year with excessive rains. Again, the Three Gorges Dam at risk, and other places. Guy, I want to ask you a question. So all that so there's higher than normal, and a lot higher than normal basically feed quality wheat, does that coming out of Australia, given its proximity then to some of these other countries, does that goes into feed channels? Does that compete against U.S. corn and other U.S. grains for markets?
Yes. Look, you and I have discussed looking at the balance sheets. Wheat's gotten tight enough now that it can't price itself in the feed grains. Although when you get downgraded production, that's where it's going to go. Just earlier this month, late November, there was 10 to 12 cargoes of Australia downgraded wheat that reportedly traded into China. China was one of the bigger feeders of wheat last year, given the price of corn. Wheat was a $20 a ton discount in China, so a lot of wheat was being fed. Historically, generally that feed wheat stays within the domestic channels in Australia, going into chicken feed, cattle feed, hog feed, because Australia has a wheat-based feed ration, but there's sufficient supplies of it this year. It is finding itself into the export markets, particularly into China. I actually had a phone call this morning, end user from the Philippines, questioning what's the impact of sprouted wheat in as far as feed value into that. So it is working itself into the market. So yes, it's going to compete with corn, but one thing this year, Dan, you and I have discussed is last year we had that cushion in the feed grains complex of wheat. So we could always, particularly hard red winter wheat, but it was about 6 months ago, hard red winter wheat went to a premium to Chicago. We no longer have that luxury to be able to feed a lot of wheat, and we don't have that safety net. So again, as production forecast changes coming year, that's going to drive corn prices a lot quicker.
And we do want to talk about more broadly here, grain stocks. And Dan, turn to you because you express this often as looking at the world stocks minus China. Talk about that, because again, China is such a kingpin in all of this.
Well, yes, and Guy and I have both talked about this, and Guy has lived it from his time in China. The challenge of getting a hard, reliable number on Chinese stocks, and the difficulty of China themselves probably doing that again. But when you look at say for wheat, the world minus China stocks to use is 21.4%. Now that's basically the lowest since 2007, 2008. And now the world stocks to use 35% looks like, well, yeah, we're a little bit low, but no problem. But when you take out that China factor, that wedge in that market, we're tight. And to me, that from a supply demand point of view helps to explain some of the tremendous wheat prices that we have. So it's not so much explained even by a little bit of tightness in US stocks, by the world numbers, but the world minus China numbers do provide a lot of support for the type of the height of prices right now. And for feed grains, world minus China corn, 10.6%, but again, that's projected for this year. But again, that's got the South American crops that are projected to be very good in it. The came out of last year at 10.2%. Again, lowest in 7-8 years. Tight situation. 25.8% stocks to use on the world. So I guess that maybe the best way to compare that 10.2% for U.S. corn in the 2021 market year that we just came out of, compared to 12.3, 12.7, 14.3, the 3-4 years prior to that. So tight situation. And I would say for soybeans, it's not, since China doesn't have many soybean stocks, basically what they bring in, and they produce some, they pretty much use the world minus China stocks to use numbers by the USDA about 26%, the world number about 27%. So that's not as much of a factor there. But I guess, again, not to be just a worrier, but I guess we're economists, they pay us to be worriers. La Nina hanging around, crop input issues at hand for some major crops, particularly corn with particularly feed grains with the reliance on nitrogen fertilizer. Again, if we are unable to get all the acres out there that we plant, or even if we do and they have less fertilizer on them, you've got factors working against production next year, much less the weather. And we come out of this year with questions about where we're going in 2022 on the production side. Guy, am I thinking correctly?
Yeah, look, Dan, your point on the soybeans is well taken. It was about 25 years ago, China decided they were going to import soybeans rather than produce it. And I think the interesting thing with corn is I think we're with feed grains and corn where we were with soybeans in China 25 years ago. Look, the Chinese corn stocks number, nobody believes it. I think it's exceptionally tight, and you got the question of quality there as well. I think China's also made the decision in the wake of the African swine fever. They're actually going to produce the livestock and livestock products in country and import the feed grains rather than import the meat. Just last week, they reintroduced import tariffs on pork and some other meat. So they're going to produce it in China. The exception of that being beef, and Kansas being the second largest beef state. The Chinese have got a taste for beef and they like it and they're going to continue to eat that. But they're going to produce the livestock in China. I think that bodes very well for the imports of corn, particularly, and other feed grades into China. And we're seeing that in grain sorghum as well as corn.
I want to jump on that grain sorghum comment. U.S. grain sorghum exports really jumpy and spotty here within the last week. We were up at last week recorded on December 16th. Saw it on earlier this week report, 12.5 million bushels, and a lot of times we're just kind of limping along at 1 or 2 or 3 or almost none. So it's very, very inconsistent and spotty. So there's still hope that China will come strongly, continue to remain strong in the grain sorghum market, which helps Kansas and Texas a lot. So, but it's sort of a maddening thing if you have I guess thoughts about where grain sorghum goes, and domestic usage in China there's more than just feed usage. They have domestic alcohol consumption. Isn't that right, Guy?
Yeah, trying to get a handle on that. I think probably 4 to 5 million metric tons goes to that domestic baijiu production and food consumption. The other big difference is it's your state-owned, government-controlled COFCO, which really drives the imports for corn and soybeans. And that's very much an execution of government policy, where commodity like grain sorghum is more driven by the private trade. It's sort of off the radar because it's not such a huge volume commodity. And I think that goes some ways to explain sort of the lack of steady consistency in there. But we have seen very, very good premiums for grain sorghum. And I think that's going to continue in the marketplace, as it's anywhere from even money to nearly $2 a bushel premium to corn. And that's being driven by that inelastic baijiu demand. I ask if baijiu, it puts it in as sold as a health food product in China. I don't know if it's a cure for COVID, but it could possibly be.
Well, before we have the both of you opine on what's likely ahead in 2022, having said all of this, grain prices remain extraordinarily high compared to the historical norm. That's the bottom line here, Dan.
And going back to what we had talked about early on, grain prices are high, but I don't know of anybody that is discounting the production cost issues. So we have sky high prices, and we have, by our estimates, still some profitability in this, but it's not the same situation as if you had the same costs as before, and then you had a supply shock and drove prices sky high. We have these issues, supply chain oriented, that have and other factors, of course, that have driven prices to the high side. But the whole complex of ag input and output costs have gone up. So I just think both for domestic U.S. producers and Guy for international buyers, this is the time to think about some sort of risk management strategy to protect yourself, not so much from high prices occurring unless you're a buyer, but whatever your costs are, and whether you're a buyer or seller, we're at the mode of having to really manage the risks of this. And there's enough risk out there that of absorbing high input costs and having prices drop at the wrong time that we have I guess an extraordinarily high financial risk coming into this coming year. And that sounds like I'm just rattling the saber, but the high input costs have put us in a risky situation. So we need to figure out how to manage the selling prices, or vice versa if you're buying these grains on the other side. It's just really a challenging situation. And I know we out of K-State and what I'm doing, and Guy, as he helps with international folks, we'll be talking about that quite a bit. It's really the time to try to manage your downside financial risks, because I think they're substantial going into 2022.
Yeah. Look, that risk management is key. And we look at price risk and the volatility. And I think these markets are going to give the producer the opportunity to lock in some profitable high prices. I think it's also going to give the end user the opportunity to lock in some very competitive lower prices as they secure their supplies. But I'd just like to expand that risk comment a bit along the supply chain. You know, the security of supply is a big issue now, as we've seen these supply chain disruptions. You don't want to run out of feed when have a bunch of hungry dead chickens out there. So that's making a lot of companies rethink what's their minimal stock and inventory that they're going to carry. They're increasing that. That's at the same time when interest rates are going up and increasing financial costs. So it has a lot of CFOs scratching their head a bit on how they're going to manage that, as well as the logistics. We've sort of been blaming COVID for a lot of these supply chain disruptions, but there's a lot of other issues factoring into that are coming into it, labor just being one of them. And as we try to secure that supply chain, we're actually seeing a lot of this supply chain, particularly on the manufacturing, move quickly out of China into other more secure areas. A lot of it's moving back to Latin America, Mexico, into the US as well. And that whole disruption of supply chain as they shift the trade flows is going to be key there as well.
I'd like to add in that that to manage the supply issue, the guy I was mentioning, I think you see that in Kansas grain basis, particularly for feed grains, strong basis levels for in a number of locations. And there seems to be a human psychology of risk management as people who are buying grains are seeking to secure supplies. That ties right into, Guy, what you'd said in terms of people rethinking how they manage their inventories. They're not as prone to think, well, if I don't buy today, it'll still be there tomorrow. That's at the mode now, where if I don't buy today, somebody else might buy it and I may not get a chance tomorrow.
Yeah. Sort of just making a comment on upside, downside, just quickly, just some key things I'm watching going forward is I'm actually quite optimistic in bullish ag commodity prices. We've seen historical highs across the whole complexes. I think that's going to continue to be driven by your tightness in your stocks to use. We've got to replenish those stocks, and that's going to be more than one season of good prices going forward. We're going to see the underlying impacts inflation continue to push that higher, particularly as investors and the money guys look at ag commodities as a good hedge against inflation. Then to bring it back to the geopolitical issues, there's sort of a double-edged sword there. We haven't talked about Russia and the Ukrainian situation. If we saw Russia and the Ukraine situation sort of get a bit hotter, that would actually be quite supportive of commodity prices, I'd suggest, with Russia being one of the biggest producers and exporters of wheat into the global marketplace. You know, by contrast, we talk about China being one of the bigger buyers of commodities across the board. You know, a problem in the South China Sea would be quite negative prices, because we could potentially lose or frustrate a significant buyer or purchase of those commodities. And the other thing on the downside I'd suggest is, look, these supply chain issues aren't going to go away. And they could get more complicated before they sort of smooth themselves out. We've seen government intervention in a number of these markets which I'd always suggest is not a good thing. Government policies always tend to get it wrong and have the reverse impact of what they intend. Although it's made with good intentions, they could further complicate things. So we just need to keep a close eye on our supply chain, whether I'm a grower, a wheat grower in Kansas, a corn grower in Illinois, or whether I'm an end user in offshore.
What's on your radar, Dan?
A problem in the South China Sea would sure affect the direction of flow of grain. And as political leaders in different countries would come in and do whatever they might do in response to aggression in that part of the world, then does that include trade embargoes from one country direct to another? If that happens, people still have to eat off in these different places, and again, the flow would move around some. I think overall, I know I agree, Guy, with exactly what you've said, but I do question that what high prices and high profitability will do in terms of the long term of high prices and high profitability staying around. Again, if markets tend to undo themselves, there's an old adage that's so true. The best cure for high prices is high prices. Best cure for low prices, low prices, because what it sets in motion for people, both producers and sellers and users, what they do in response to them. So it's hard to see in the short run, given all these constraints on input supplies, et cetera, that we'll see things turn around immediately. But we don't want to fall asleep at how much incentive there is to take actions that will take prices and profitability lower. So that's what keeps me awake at night. But probably won't have to worry about it until about November, October of next year, Guy.
Well, that is a great overview of what's been going on, of influence in the grain markets, and what is ahead that needs to be very much at the forefront as producers and others watch these markets going into the new year. And we do appreciate the both of you taking this time to pass along these great thoughts and this good insight. Thank you, and have a happy holiday to both of you.
Thanks, Eric.
Merry Christmas, Happy New Year's to you. Thank you.
Here with us, Guy Allen, the senior economist with the IGP Institute at K-State, and Dan O'Brien, grain market economist, K-State Research and Extension. And this is Agriculture Today.